Hi Fools, and welcome to another Ask a Foolish Question video from the Motley Fool. I'm Owen Benelak and I'm here to answer the question of Connor Middleton. Now Connor is a, I would say, fortunate young man. He's 17, he is going to be 18 and he's going to have £2,000 to invest, and Connor quite sensibly asks, how should he invest this £2,000? Should he invest it in a tracker fund? Should he invest it in an ETF? Or should he perhaps buy some individual shares? Excellent question, 3 excellent ways to invest. Now, the first thing I'd say is 18 is, there's a lot of options when you're 18. There's a lot of calls on your cash. So possibly you should be sure that you want to invest this money. Maybe if you're going to need it in the short term, it shouldn't be in shares. Shares can go up and down quite wildly. So if you're going to need that money to help you through university, maybe to buy a car, anything like that, possibly don't put it in shares. Beyond that, your three points are exactly on the button. An index tracker and an ETF are very similar. An ETF is effectively an index tracker that you buy and sell on the market. So I'll put those in the same pot. What you're doing there is you're getting massive diversification. You will basically benefit as the market rises and you'll suffer as the market falls. And that's a great way to get exposure to shares very cheaply, not take any particular company risk. So you're not going to be shocked and see your money halve overnight unless there's a massive bear market. But equally, you're not going to invest in the next Apple because you're buying everything. We like to invest quite often also, it doesn't have to be one or the other, in individual shares. Your problem there with £2,000 is you always want to look at costs. You have to pay dealing fees, you have to pay stamp duty, there's a spread between the buy and the sell. And with a £2,000 investment, you're not going to really be able to buy a diversified portfolio and keep your costs down. You're probably going to only be able to invest in a couple of companies max, which, to be honest, Connor, that's not ideal. Now, if you think you're going to have a lot of money coming in over the years ahead, this might be a good opportunity to learn. You may say, I'm effectively going to pay an education. It's going to cost me £2,000. I'm going to find out what it's like to buy individual shares. Who knows, maybe you'll buy the next Apple and you'll be writing to me from the Bahamas. Maybe you won't. Maybe you'll buy the next Marconi and that'll be a valuable lesson. My instinct would be to say probably if it's genuinely the basis, bedrock of a new investment portfolio that you're going to add to for the next 30, 40 years, which is how you should do things, then I would probably look at a tracker fund first and then start to add individual shareholdings in the years ahead. So that, I hope, answers your question, Connor. And everyone else, if you have any other questions, please email foolishquestions@fool.co.uk and I or somebody else will happily answer them.